Hello, this is Ryan Mallory for SharePunter.com. Today I want to do a video about Bollinger Bands and just how I use them, for the purposes of getting into trades and when not to get into trades, and then also for taking profits. I don't use them strictly for the purposes of getting in a trade. For instance, I see a trade like, for instance, in JACK, it's hitting the upper Bollinger Band, so automatically I go short, or it hits the bottom Bollinger Band, automatically that's a signal for me to go long. I don't use it for those purposes. More so, it's determining the exuberance, or when there's too much euphoria in a trade and I'm long on that particular stock. It's often a good way for me to, as a check against my own emotions, as a way to determine, am I being way too overly optimistic? Do I need to start taking profits off the table? So I'm going to give you guys about 5 or 6 examples, starting here with JACK, Jack in the Box. And with this particular trade, this was a real trade, a stock that I had to make a real decision in. And what how I want you guys to look at this is look how back on October 14th, you had a very nice breakout play, a legitimate trade, but you get well outside of this Bollinger Band, and the first question is, in your mind, without looking at the Bollinger Band, you say to yourself, "Man, look at this thing! It looks like it's going to go through the roof." And then you see it go up the next day, and you're thinking, "Man, this I am on to something here. I might see 20-30% before too long." There is a lot of buyers in this particular trade. Next day, the same thing. Now, I might be tempted to get out on this particular day here, or at least take half the position off the table. But when you get something like this, where you got an exhaustion gap or a gap outside of the Bollinger Band, there is a very good likelihood that you're seeing the end of the run here. And in JACK, you can see we consolidated, moved up a little bit higher, and then the floor just came completely out from underneath it, moved much lower. Now, when it hits upper Bollinger Bands, the possibility of seeing this kind of a decline isn't always the case. There was some bad news, I believe, that came out on this stock that sent it much lower. But one of the things that I constantly preach, if you guys have been following this website for any extended amount of time, you guys know that I tell folks to consistently extract profits from the market. It's okay if you get out too early at times. It is good to let winners run, but do so in a sensible fashion. If the stock is going going up way too much and way too soon, that's a good idea. That's a good time to start booking profits, because stocks don't go up forever. And I get excited about any stock, when you're seeing like 5, 6, 7% gains, and you're just seeing this multi-day rally that just has unending strength to it. And we got that in JACK, but you can see that these kinds of rallies just don't last forever. And in this particular case, you have this exhaustion gap right here, well outside of the Bollinger Bands. And for those who don't know what Bollinger Bands are, it's basically a standard deviation of a moving average. And in this case, I'm using like a 21-day moving average. It's really the same thing as a 20-day moving average, really. But it's two standard deviations of price action outside of that 20-day moving average. And when it goes beyond that, it's just an area where price doesn't typically venture into it. Inside of it, that usually shows you that price is well contained. But when it starts drifting outside of these Bollinger Bands, it's a good possibility that the stock price is getting away from it, and there could be profit taking in the near future. Now, not all stocks are like that. Some stocks go on these multi-day rallies far outside of the Bollinger Band, both to the upside and to the downside. I even get a little bit more worried when I see a breakdown to the bottom of a Bollinger Band. For instance, like with JACK, you had a huge breakdown here. If I was shorting the stock on this particular day, I'd be getting out of it on this one here. And I wouldn't be waiting for this candle. I would just take all my profits off the table here. And the reason being is because bounces in the market seem to be a lot more severe after a decent correction. And in this case, after hitting 20, it goes all the way up as high as $22. There's basically, over the next 2 weeks, there was a 10% rally. So the use of the Bollinger Bands, they go both ways. When there's a breach on the uh, upper channel and when there's a breach on the lower channel, very good indications that you might want to consider taking profits off the table. Now, let's look at another example here. Let's take a look at CERN. This is another trade that I base my exit off of the Bollinger Bands completely. So right here you have a very nice run into the outside. You had a flag. You had a flag pattern here, and then it finally broke through on 12:16 is where I got in at, and then the next day just saw a huge move to the upside. Great, wonderful, things are looking very good. However, when I saw that move and I saw it giving back a little bit, first of all, I took profits. I took half off the table right here, and then the next day when I saw some of this price action that put the price back inside the Bollinger Band, I felt like there was a good chance we would see a correction, and we did. Since then, I've gotten back in. I got back in just a couple of days ago in it. But when you see these huge price corrections, now in this case, you don't have to get out at this point. I think it's good to take half off the table, but you don't have to get out because it's not. And typically, what I like to use is a 50% price move where 50% of the candle's body is outside of the Bollinger Band. When I get that, that's an automatic take half off the table at least, or close the position just outright. And in this case, it wasn't quite that. It was maybe about a third of the candle's body outside of the Bollinger Band. But it was enough for me to take half off the table and then see what it does the following day. The next day, we were seeing some weakness. I decided I'm not going to hold on to it any longer, and I get out. And what happens thereafter, we see a correction of about $1.50 or two in the price of the stock. Doesn't mean that you can't get back into it again, but let the stock settle down some, come back to earth a little bit, and then jump back in on it. Another stock that I applied this to recently was CX. CX had this breakout right here. It was very good, and then it pulled back some, and then we had this bullish flag pattern here for a few days, and then finally we got the breakout. But when it broke out, it did a little too much too fast here, and what we ended up getting was about 50% of the price stock of the stock's price move from that day outside of the candles, outside of that range. So I took half off the table, and then the next day we had some selling where it wants to creep back into those Bollinger Bands. That's why I use these Bollinger Bands. That's why you see me in the chat room talking about it a lot, and just some of my analysis, because I feel like that when, not so much feel, I know that when stocks creep outside of that, whether it's the upper Bollinger Band or lower Bollinger Band, your risk reward ratio is getting drastically. Your reward to the amount that you're having to risk is getting much smaller. So meaning you're not going to be able to profit as much as compared to what you're risking at that point. So another way, if you don't want to take profits off the table, consider greatly tightening the stop. I mean, right near the upper Bollinger Band. If the price is going to continue to move, it'll do so likely without even touching the inside of this Bollinger Band. If it wants to continue to break out, it'll do it all outside. But on CX, I felt like we got the move that we were looking for, and I decided to start taking money off the table, and in doing so, I was able to save myself from losing a lot of my profits, and actually get out close to the very top of the stock's move. So if I had held on right now, I'd be holding a position that's worth 2% less in value than what it was when I got in there originally. YZC. You can see here, this is an example of how a stock can move outside the Bollinger Band for an extended period of time. You look at this here, I mean, we're just all over the place outside of the upper Bollinger Band. And then finally, you can see examples of where it gets way up there and then it just starts pulling back. And so, yes, these areas here where the price moves drastically outside the Bollinger Band, they're nice and lovely to be a part of, but they don't happen as much as what we see when the price gets outside of the Bollinger Band and then starts pulling back, like we saw in CX and CERN and Jack in the Box. That happens far more often, the latter of which I just described. And you can see right here again, we popped out there, we had an exhaustion gap, and then since then price has come back down some. DirecTV is an example of what happens to the downside. You had a huge breach to the bottom side of this Bollinger Band, and right thereafter we had a 2% correction or so, followed by a number of sideways price action. Now, if you still wanted to stay into it, you could have gotten out of it right around here when the market closed that day back in early December, and then wait for it to pop. And when it did, you basically got a nice low risk, high reward setup here that would have allowed you to profit from another move downwards. And the same goes for a stock like PUDA. Yes, it can move outside the Bollinger Band and do so in a very enthusiastic manner. However, you can see, like for instance right here where we did pop, the whole body candle is outside of the Bollinger Band, and within 3 days the stock goes from $16 or $17 a share almost, all the way down to $12. That's like a 25% drop just in a few days. That's why I'm trying to say that the street or the retail investor or the people who aren't really skilled in technical analysis and especially the psychological aspects of the trade, they get excited when price moves like this. They think they've gotten into the next big stock player, or the next Apple, or the next Google. But what often it's mistaken for is just in the words of Alan Greenspan, who I don't really care for that much, but irrational exuberance. And that's what you have in these kinds of stock plays. You get investors or traders who are getting very irrational. They think that, okay, it's at 1680 now, it's going to 20 within the week, and it doesn't. It comes right down, and then they're left scratching their head. They'll call the market rigged. They'll say that it's stacked against them, and they quit trading completely because they just grow so frustrated. So another reason why I use the Bollinger Bands too is to protect my mental capital, and I talk about that as well. That mental capital is just as important as the actual capital you're trading with, because if you start doubting yourself, if you start seeing winners turn into losers, you start down your ability to trade in the markets, and you just grow frustrated, and that is not what you want to have happen. If you don't constantly you're never going to get out at the top of a market, at the top of a trade, and you're never going to get in at the bottom of a trade. Rarely, and if you do, rarely does that ever happen. But what you want to be able to do is consistently extract profits to, one, increase your mental confidence, your ability to trade, and to constantly be building on that capital that you have in your portfolio. But allowing stocks that move like this, parabolic, and then not take gains at least off the table and tighten your stop loss greatly is complete foolishness, and you risk these kinds of gap downs as a result, because just too many people are trying to get out of the stock at the same time once the stock makes a huge move up. So I hope this helps. I hope you guys are able to learn a little bit off of how I use Bollinger Bands, and it's a little bit unconventional, I guess you could say, in the manner in which I use them. But I think that it's a great way to basically guard against your own emotions and desires to get rich quick. So until next time, that's my educational video for now, and good luck in the markets.